All right, welcome back, everybody, to Wook Capital Management's weekly Wook and Review broadcast. This is Rod Alsman. I'm the managing director at Wook Capital. Before we get things started, I do need to ensure everyone knows that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. So with that mouthful out of the way, everybody, thanks again for tuning in this week. Just as an FYI for first comers, our Wook and Review broadcast, we have the audio, of course, here on Spaces. We're going to do our best to pin content to the Spaces as we progress through the discussion this afternoon. In the Wook Discord server, if you'd like to follow the live screen, I share my screen and kind of walk through different articles and highlight some different charts and the like. So if you do want to get visuals and audio while listening in live, you can do that. Wook.gg in your web browser will bring you to the Discord. The only ask we have is to introduce yourself when you join, and then we'll give you full access to the server. But it's A-okay if you just want audio only. So this is our second week where we're going to go through the prepared content in our new format. So for those who are unaware, we do send this weekly newsletter out on Friday mornings. This is our 21st edition of the Wook and Review. So you can, through the link in the profile here of that Wook Capital handle, you can click the little newspaper icon, and that'll bring you to this page where you can join the mailing list and get that at 9 a.m. on Friday mornings. And then we follow up, of course, most weeks with the 4 p.m. discussion. So with that said, I'm pulling up here this week's Wook and Review. So I have 3 topics for this week. As I mentioned, our format change. We're going to go topic by topic and welcome anybody who's in the audience up if they'd like to chime in and join the discussion. I think it'll probably be a little quicker this week, right? It was a shorter holiday week with the markets closed on Monday. There was a decent amount that happened this week. So for as long as we have a productive, thoughtful conversation, we'll keep it going. It's 4:06. I do suspect that we'll wrap before 5 or 5:30 today, participation dependent. So with that said, Joe has it pinned here, the Wook and Review thread. If you don't have the newsletter or you didn't see the newsletter, it kind of summarizes what's in there. So I included a graphic, and obviously today markets closed down meaningfully. NASDAQ down 1.7, S&P and Dow 1.1, the Russell 2000 a little less than that, volatility up a little bit again. So over the course of the week, markets were down, high, low single-digit percent. So this, the why behind that, the primary why behind that, as shown in the graphic, is this uptick in what the market is pricing for future Fed funds rates. So the short-term overnight lending rate, the federal funds rate, has, for much of late 22 and really the first month of 23, markets were expecting that the Fed would begin to cut rates by the end of 2023. And you can see in the graphic where, really since the start of this month, market pricing for the January 24 Fed funds rate has risen by almost 100 basis points. It's risen from 4.2-ish, 4.1 and change to over 5%. So that pricing in the market serves to deflate equity valuations to an extent. So I think that's a primary driver of why indices have been edging down. Obviously, there's financial data as well that goes into the mix atop just rates. So we can talk a little bit about that, but we'll spend a little less time talking about the macro today, although definitely welcome input. from folks as we get into the topics. Before we get into the first topic, though, I do want to make everyone aware we will be having our third monthly book club on Tuesday night, so 8 p.m. Morgan Housel wrote The Psychology of Money, and I found that a really excellent read. I think it's, whether you're a new investor, whether you are a seasoned investor, there's comments from Howard Marks, I think even Buffett, like a lot of, well-known seasoned investors had good things to say about the book. So hopefully you'll take the time to read it. If not, I think you can participate and listen in Tuesday night at 8 p.m. and hopefully walk away more well-informed, even if you don't opt to read the book. We will be sharing what our balance of year books that we expect to get through, ideally next week, we're targeting. So every last Tuesday of the month at 8 p.m. Eastern is the anticipated schedule for those ongoing book clubs. So again, next one's coming up on Tuesday night. And with that said, let me get into the content. So first story or first topic that I included in this week's newsletter, I included the headline, "More AI, Please." So NVDA, the graphics processing unit maker, has seen a pretty impressive resurgence in its share price year to date, as the Microsoft ChatGPT language learning model has gotten a lot of hype, and AI has gotten a lot of hype. And fittingly, NVIDIA leaned hard into the hype. They used the phrase AI something like 18 times in their prepared remarks, or not prepared remarks, excuse me, in their press release for their earnings this week, and then 75 times or so in the actual earnings call itself, between prepared remarks and Q&A. So they know the market likes the word, and they use the word a lot, and the market rewarded them for using the word a lot. Perhaps not so much for the near-term results that weren't so impressive. NVIDIA stock is now trading at a very rich valuation on most forward measures. So, the forward price to earnings, as I'm seeing from Koifin data, is over 52. The forward enterprise value to EBIT multiple is 45 times. So some pretty rich valuations, which mean that the market must be pricing some impressive growth in. And to be fair, I included a link to a Reuters story with some estimate from Gartner. Gartner is a research firm. I actually worked with them in the past while at Ryder on electric vehicle and autonomous vehicle outlooks. I was impressed with my experience working with Gartner. But regardless, Gartner's estimate is that the share of specialized chips like GPUs, those graphics processing units that handle AI computing, which NVIDIA owns the vast majority of the market for GPUs. It's over 80, it's nearly 90%, I believe. To be fair, this is not my area of expertise. So if there's anyone who is a GPU specialist or a chip specialist who has some detail, please would welcome you to come up as a speaker and share what you're seeing. I guess the bottom line for the conversation prompt is, with a market cap that's far larger than Intel and AMD, is the growth opportunity large enough to satisfy investor expectations? So markets are forward-looking. Markets are looking at future growth, trying to discount those prospective future cash flows. So when you look at NVIDIA stock at nearly $600 billion market cap, the market's clearly pricing in a lot of future growth, considering the current multiples that I noted before. So I think the consensus I'm sensing from people throughout the tech space is that AI, these language learning models, are a real opportunity, and it's much less fluffy than, say, metaverse and AR, VR in the general view that I'm understanding. But that said, right, it comes down to, is the opportunity going to turn into cash flows soon enough? The Gartner point that says that the share is going to rise to more than 15% of data center chip usage. GPUs will be more than 15% of data center chips by 2026, and that's up from less than 3% in 2020. So I don't know from a longer term perspective, does that 15% grow into the 2030s and beyond meaningfully? Do GPUs eventually end up being the majority of chips used in data centers? Obviously, these are things that growth investors need to know or should have insight into if they're looking to make investments into NVIDIA from a fundamentals perspective. Clearly, year to date, there's been all of the AI hype. I noted how many times they use the word AI. And I've seen data that show, and we talked about this in, I believe it was last week's Wook in Review, how data from VandaTrack has shown that NVIDIA, NVDA, is one of the top 5 single securities that retail inflows have gone to. NVIDIA, Tesla, Apple, Amazon, and the SPY were the top 5, not in that particular order. So clearly there's been this resurgence in risk appetite that started at the beginning of the year that's kind of tapered a little bit as maybe markets have realized they got way ahead of themselves. But a lot of money's flowed into NVIDIA, right? The market cap is almost double where it was at the most recent trough in 22. So this AI opportunity is real, I think. Clearly the experts think that GPU usage will continue to grow. It's the largest player in the space. That is a large profit pool for NVIDIA to potentially tap into in the future. But Joe, I know it's not your wheelhouse, but I would kind of open the question up to the room. You know, is there enough of a growth opportunity to satisfy those investor expectations? And I don't expect you to give me the perfect answer, but
I'd say
what do you
it's tough
think?
to argue that it's not already all priced in, but you have to also consider just like the potential mania. I mean, this NVIDIA has been a meme stock for years, and you think back of Wall Street Bets when everyone had, you know, some crazy YOLO gains on NVIDIA, and who knows? Who knows if it ever reconnects with reality? I mean, the amount of times that AI was said in the earnings call, you have to expect that was, you know, playing of an algorithm in some way, or just trying to get investors momentum and hype. But it's still, I mean, it's still a great company. You just have to think, is it overvalued? And it's, for me, it's
Yeah,
not. I like an underdog, and they're definitely not the underdog at the moment.
I think that's a good way to put it. I'm looking at the chart going back a decade, and how nice for those who bought NVIDIA at $5 in 2015 and held on with a 20x plus return depending on when they sold. So I mean that's it, right? That a lot of these when price goes up as it did, so much so for NVIDIA over the last couple of months. Um, it was at 140 around the start of the year, and it's at 230. It closed at 233. It closed that today. So it added a whole lot of value in short order. I don't know the answer where NVIDIA is going to perform going forward. I think it's clearly a leader in its segment. It has only a few competitors in the GPU space. Obviously, beyond AI, the video gaming space is very relevant for NVIDIA. I know that people talk about they are the best in class if I want the best graphics card if I'm going to build my own gaming PC, like that's who people select. And I guess it's like 3 things, right? It's gaming, it's crypto was what really helped it a lot during COVID years because people were using those chips for crypto mining, and now it's AI. So it just gets back to when you're valued at almost $600 billion, and you're making just from an outlook perspective. Again, it's closed at 233, and then if I look at the sell side analyst consensus for the stock on earnings per share basis, looking at 2025, so going out 2+ years, the average of that is under $6. So that's still a 40 times price to earnings in 2025. Um, so, the question is how much and how fast, does that growth come in, right? So we'll see what happens. I'm not seeing anybody raise their hand to come up and chime in. If anybody has any additional thoughts on NVIDIA, would definitely love to hear it. I'm not. I've never been invested in it. I think people have heard me say this before. I'm a caveman when it comes to tech. Joe knows this. He has to help me with all of this stuff. But yeah, it's difficult when there's so much growth already priced into a stock, and then it's like, what's the incremental upside from there? So I don't know that the forward risk reward is that attractive for returns from here, but clearly anyone who was invested in NVIDIA and held through the last decade has made life-changing wealth if they had a meaningful allocation of the company. So that's NVIDIA. Joe, anything else on NVIDIA before I keep going?
No, but I will agree, Rod, you are a boomer. So I can't
It's a
expect you to have
fact.
meaningful insight into NVIDIA. It is definitely not up your alley.
That is a fact. Here's a here's maybe more up my alley. I'm coming up on the 10-year anniversary of buying a house when I was 23. So we're going to talk about housing, fittingly. I'm looking at this very long chart, very long historical chart going back on mortgage applications. There's a lot of housing data points that came out this week, from mortgage applications to new sales to used sales to an interesting story on new marketing incentives for buyers. For a second, I'll talk about. We talked about housing a bit on Wednesday night for anyone who tuned in to our market open mic. So I'll try not to rehash things from that conversation. But we got data from the Mortgage Bankers Association that mortgage applications for home purchases had fallen to their lowest levels since 1995. So clearly, there were a lot fewer Americans in 1995 too. So I'm not 100% sure how they do the index, if there's like any population adjustment going on in there, or if it's like purely nominal. But clearly, not a good sign for new, or rather, sorry, for housing activity. There was a good data point today that came out on new purchases, but remember the mix. New home sales are only a tenth of the housing market, with existing sales being the vast majority. So even if new home sales ticked up a little bit, in the context of the overall market, it's not telling too much. So, oops, sorry, let me get here. So this was the story that I included. I included the link in the newsletter, and I'll kind of talk through for a second. So the headline, this is a Bloomberg story out on the 23rd. So yesterday morning, this came out. The headline is "Home Lenders Hunt for Ways to Make 6% Mortgages More Attractive." And it talks about some of the big players and some local credit unions where they're obviously seeing this significant reduction in demand for mortgages, and they're trying to find ways to spur that demand. So one of them is from this Texas credit union that's marketing no-cost refinancing within 24 months of the original closing. And the VP of real estate lending production says, quote, "We're seeing incredible traction with the offer." So basically, if you lock in a 30-year fixed rate mortgage at 6.56, whatever the current average is, if rates dropped within that 24-month window, a refinancing that would normally cost several $1,000s is a free option that they are providing to the prospective client. So the concern, but the issue there is if they don't drop, and you're still buying houses that are they're still within single digits in many markets, and at least at a national level, of the all-time highs. Buyers may be stretching themselves too far if they're relying on that sort of a thing, and rates don't decline. So I thought that was interesting. In addition to that, just from a raw numbers perspective, I mentioned it's like the data from the peak, according to Redfin, is that real estate or U.S. home values have declined $2.3 trillion, which is 4.9% from those June highs, which, $2.3 trillion just sounds like a massive number. It's a little less than 1/10 of U.S. annual GDP, so it is a meaningful number. But on a percent basis, again, it's like, okay, it's down 4.9% from the all-time highs, but the Redfin economics, research lead noted that the total value of homes remains roughly 13 trillion higher than it was in February 2020 before COVID hit. So yes, housing prices have come down off the highs by 5% nationwide. However, clearly there's still a whole hell of a lot of value or price that was added in the COVID years that could be given back further. And we've talked about housing a bit here, multiple weeks. It's a big sector of the economy. Obviously, it's a very interest rate sensitive sector of the economy. So it is definitely interesting, though, to note where markets are holding up strongly relative to that average. So sure, the average is down 4.9% from the peak, but a market like Miami is still up almost 20% year over year. Knoxville, Tennessee, 18% year over year. This is Redfin data. The Sarasota market going over to the Gulf Coast side of the state, also 18% year over year. Charleston, South Carolina, 17%. But then when you look at a northern city or a California city, New York down 1%, San Jose 3%, Oakland 4.5%, San Francisco down 7%. So the higher cost of living markets, the higher tax markets are continuing to underperform relative to Sunbelt like Florida, Tennessee, Texas, which may continue. Florida has always been a very boom-bust housing market, and it's still booming. The question, of course, is will there be a bust, or is it different this time? But as the Redfin real estate agent in the story notes, Florida's housing market is being sustained by folks moving in from the north and, as of recently, the West Coast. So, Joe, are you going to move to Florida and be another statistic?
Maybe for 6 months of the year, Rod. Get my taxes in a better place. But besides that, I don't know. It's just not the place for me. I couldn't deal with the constant rain, and the heat in the summer sounds absolutely miserable, Rod. I don't know how you put up with it. You guys just stay inside with your air conditioners and I can't.
Well, I couldn't put up with the heat of yesterday. I tweeted yesterday. I live in Hillsborough County, Florida, and for the entire month of February, in all of recorded history, yesterday was the hottest day in many parts of the county. It was a record high of 92, not too far from where I live. So, I mean, it's February, and it's already just god awfully hot. So yeah, I don't like Florida summer. as a relocated New Yorker who's lived in Florida since graduating undergrad, that's just too much. And hopefully I get a little bit more winter before it's all said and done. But you said something about tax, and I had one other story I included in the newsletter that I thought was interesting, kind of in the tax vein. So obviously you're referring to the people who move to Florida and live there, 183 plus days out of the year. They become Florida residents. They don't pay any state income tax, which is wonderful, but maybe they have a second, home base in a high tax state. That's a strategy a lot of ultra wealthy have employed for many years and seemingly continue to employ. But this tax story was also in Bloomberg earlier this week. The headline: tax breaks threaten remote work if cities start enforcing them. So you think about all of these headlines you've seen maybe over the last several years, decade, whatever, of we're going to pay Foxconn this many $1 billion in incentives to bring this many thousands of workers to Wisconsin. Foxconn was one of the ones that the per worker cost was like hundreds and hundreds of thousands of dollars in tax incentives for each job. So they're not all as extreme as the Foxconn one, but The interesting thing, right, is as this morph to hybrid work and remote work took place, the thinking, of course, is you get a high income, worker into your local, your town or your city. They're going to go into their office. They're going to consume, lunch or dinner or entertainment or whatever in that, downtown area maybe. But now in an area of remote, right, if you're giving out all these incentives to bring workers to your city, but they're not actually working in your city, how do you manage that? So the story talks about a couple of examples where, before the pandemic, quote, several New Jersey tax programs required workers to show up at least 80% of the time. One Texas program set the threshold at 50% of the time. I'm sure there are some that didn't even think about this because maybe it wasn't on top of mind at the time. But clearly, more states are thinking about this and cracking down on this prospectively. And obviously, companies who received the tax benefits have no interest in giving those back. So maybe this is playing a part in some of the return to office demands that we're seeing by some of the white collar employers. The story includes an example: software company ICIMS chose to forfeit a tax break of 13 million. They had moved their headquarters to a Bell Labs complex in New Jersey in 2017, but since adopted a quote fully flexible remote first policy with no set number of days in office. So they gave back their 13 million from the state of New Jersey, and they felt that fully remote was better for them. So just some interesting, peculiarities, I guess is one way to put it. And there's another story, talking about how much remote work is costing the island of Manhattan. We've alluded to, and I think in past programs we talked on the commercial real estate side. Obviously, we led off this topic talking about residential real estate and the lack of demand there, and the ways people are trying to drum up demand there. Well, on the commercial real estate side, obviously, if there's a lot less demand for office space, that all else equal, the price of the office space goes down. So, New York or Manhattan in particular, it's being cited as a $12 billion a year cost to that part of New York City. So just a lot of interesting stuff going on in housing and commercial real estate as we continue to figure out like what's normal after this pandemic. I don't know if anyone listening has any experience firsthand, whether they've been in the market recently for property or as an employee, if they've heard of any maybe increased focus on getting back into the office from their employer. Again, we'll welcome anyone who'd like to share input on what they're seeing or experiencing, or if they've seen any other data points that are interesting to share. While we wait to see if anybody raises their hand, I'll read a quote from the story. Quote, this is the story talking about the impact of these the hybrid work and the tax offerings. Quote, compared to states, cities have much more to win or lose depending on where workers live and whether they commute downtown and buy lunch at the local deli. The ultimate fear is that without these workers, cities might drop into an urban doom loop. Retail and property taxes dry up, commercial real estate values slump, social services are cut, and crime spikes. So there's your bear porn from me for the day. The urban doom loop. Joe, what do you see in San Diego? I know you said out there it's a very laid back vibe. Is remote work in the folks that you engage with the same mix as it's been, or have you heard anything?
Yeah, I would say remote work's still pretty hybrid. Like most people I know that do work remote here are still going into the office a few times a week. So it's not full remote, but it's also a city that's pretty easy to commute around. Like everything's 20 minutes away max. So there's no real struggle to get to work. Like you live in LA or Seattle, the traffic can be mad, and people really are miserable commuting. So it's a different story there. But here it's pretty low key, so it's not so bad. And I know some people that go into WeWorks and things like that. So there's still plenty of people actually going into work.
Yep. And that was something we talked about on Wednesday. The stat was something like only 13% of workers had actually been like fully remote, which seemed low to me. I don't know what the source was on that. That was shared on our Wednesday open mic, but had been fully remote during the peak of the pandemic. And the reality is, there's only so many jobs that can be done remotely, right? There's a lot of work that has to be done in person. You need to be there. So we obviously, for what we do at Wook, can work remotely. I mean, we literally have people on both coasts. You in the southwest corner, and JP in the northwest corner on the west side, and me on the Gulf Coast, and Han and John on the Atlantic coast of
We
Florida.
need
So,
someone up in Maine or something. So we have all corners of the U.S. mapped
yeah,
out.
when I hire an analyst later this year, that'll be a prerequisite. They've got to be a Canadian, and they have to live on one of those islands off the east coast of Canada. It's mandatory. All right. Well, then we'll move on from housing, and real estate. But yeah, I guess in a nutshell, demand remains pretty weak, even though you saw new sales edge up. You're at really low absolute levels, and the 30-year average has ticked up again, right? Um, as the 10-year has ticked up again. So I'm seeing bankrate.com at 6.94%, so just shy of 7% interest rates, which again, you compare that to a year and change ago, and 2 or 3% fixed rates. Remember, US mortgages are almost all fixed rate mortgages, whereas in other parts of the world, there's a lot higher mix of variable rate mortgages. So you have this lock-in going on where people bought a house, they paid a lot for it already in 21, 22, whatever. They locked in a really low rate, and now the price of the house is maybe flattish, maybe it's gone down a little bit. And what are they going to do? If they sell it and they try to move, they have to relinquish that very favorable fixed rate mortgage at 3%, let's call it, and now they're going to lock in at 7%. So some of the links I included did note this shift toward more adjustable rate or ARMs. Still, mix is still pretty low relatively. I would not be surprised to see an ongoing shift towards adjustable rate mortgages as rates continue to stay high and move higher prospectively. But yeah, it's a real quandary. People can't take that fixed rate mortgage with them if they went to a different property. So I think it's reducing mobility, which inherently puts even more pressure on the ability of labor supply to go where demand is, unfortunately. But such is life. So moving on to the last topic then that I included, which had some good graphics in the stories. This subprime automotive loan delinquency graphic earlier this week in the Wall Street Journal I thought was really excellent. This is Moody's analytics analysis that was shared with WSJ. So loans that are 30 days or more delinquent. And this is specifically subprime. So we're talking about folks who have a credit score below 660. And you can see from the graphic over the last almost 20 years, clearly there were very high delinquencies amid the great financial crisis. But in some of these subprime borrowers, we're actually getting toward the levels last seen in the GFC. So for the worst creditworthy borrowers, it's actually above GFC peak levels. And even at the higher tranche of subprime, we're still talking about the highest delinquency rates since 2011 for the folks in that 620 to 659 bracket. So it's subprime, which is just a portion of the overall automotive loan market. But I thought it was important to kind of talk about this because we're seeing this stress in automotive delinquencies with unemployment rates at 50 plus year lows, with pretty much anyone who wants a job having a job or being able to get a job. So it does show you the stress that some consumers are facing in that they're still employed and that they're still struggling to stay up with what maybe they got a car loan or they had to get a new transportation solution for themselves in the last couple of years, and with how high, as we've talked about extensively, automotive prices had gotten, they had to borrow a lot more money, and now I saw that used car rates, as of what I saw last night, a new not a new a used car loan for an incremental loan done, say today, the average rate on that is 10.5%. Now, clearly for these subprime borrowers, we're talking about even higher rates than an average across the spectrum. But that's a really high interest rate relative to where they were just. I remember used car rates being 3, 4, 5% just a year or two ago. So again, with rates really going haywire, it's just stressing some of these consumers. So the other part of the topic is talking about some of this discretionary spending slowdown that's being experienced and anticipated by some of the big retailers. So Walmart reported earnings this week, Home Depot, among others, reported earnings this week. And Walmart, this builds on a quote from Amazon's Andy Jassy in like January, where they noted that they're seeing consumers really being more deal oriented and pulling back on spending. So Walmart noted in the fourth quarter that they began to see consumers spending more cautiously. Obviously, they have different items they're selling inside the store, so nominal sales results were really good. But from a profitability perspective, Walmart selling more food and staple items is not great for their profit margins because they really benefit from selling you apparel and other discretionary items when you come into the big box Walmart store. So they saw challenges on a profitability perspective. The outlook wasn't so great that they shared with the market. The quote from the CEO was that it's obviously not as clear to Walmart what the back half of the year looks like. On the Home Depot side, they also noted that consumers are becoming more sensitive to higher prices finally in the fourth quarter of 22. And I don't have the graphic included. Unfortunately, I had grabbed the link last night, but I didn't send it to you, Joe. But it was a graphic of Home Depot big ticket items. So it was items over $1,000, and it was seeing a real big rollover. So it was one of those, I think, a chart almost like a triangle where the high point in the middle, right, on the left-hand side, and the right-hand side, the points are lower. So you saw a huge peak in Home Depot's percent change for those big ticket items amid all the stimulus in 2021. And as 22 went along, that kind of sloped down on the right side of the triangle. And now we're going to be seeing negative comps in 2023 for Home Depot. And clearly, home improvement, if there aren't home sales, there's less home improvement activity. So they're going to give back, I think, some of the performance they saw in COVID from a business perspective. And you're just getting warnings from these retailers that the consumer on the discretionary side is starting to really feel it. Maybe they're running out of gas. We've talked extensively in more of our economic-oriented discussions about all the accumulated excess savings. I think we did last week. We had put up that great chart that showed savings rates and showed the excess savings. And at some point in the second half of this year, many economists believe that the accumulated excess savings from the COVID era will be exhausted across the average consumer. So it's definitely a lot of question marks for the second half of this year. There's the student loan repayment situation, right? At some point in the second half of this year, it is expected that depending on how the Supreme Court rules, either people are going to get some of those debts, waived off, or no, they'll need to begin repaying them again. And that's an incremental $60 billion in annual loan payments that, nobody knows precisely what mix of those payments are actually being saved versus consumed. But in the stories I've read and the anecdotes I've heard, I would argue that the majority of folks who are who have student loan debt haven't been saving those payments. They've been consuming those payments instead. So the consumer, while they've clearly continued to be strong, right? The data out this week showed stronger consumer spending habits, at least at the start of the year, and and thus a resilience in kind of the core inflation the Fed has wanted to see roll down and continue rolling down, or ticked up with the PCE this morning, right? That's why the market, I think, reacted negatively, and rates rose further this morning. Expecting the Fed will have to tighten further. So yeah, that's on the consumer side. There's some worrisome signals, in the subprime space with automotive. There's some worrisome signals from what big retailers are sensing for 2023. I don't I don't mean to sound like a bear, but what goes up must come down, and mean reversion is a real thing. So I tend to believe that if the consumer, unless there's going to be some incremental, stimulus type packages, which are entirely possible. Although from a House perspective, I doubt that the Republicans are going to agree to something like that, and there's a real shock to the system. That cash reserves are running down. Yeah, Joe, what are you seeing in that context?
Well, it's tough. I'm in, Southern California, and typical income here is a bit higher, but of course, consumer goods are more expensive. I mean, I think we're over the peak of the egg craze. I mean, we saw eggs were $10 um, a dozen, and I don't think it's quite there anymore. So that's good. And yeah, besides that, it's nothing atypical at the moment here.
Well, that's all I had from a prepared content this week. Not everyone from our team was able to join, but if there's anyone in the audience who wants to chime in or expound on any of the topics that we talked through, certainly welcome you to come up and do so. Otherwise, we can wrap at the top of the hour or sooner and give folks an earlier start to their weekend.
Rod, you make any notable trades this week?
Um, did I make any notable trades this week? I had been buying. I didn't trade it this week, but I had been buying a lot of XRT for the retail ETF puts in the beginning of the month, and it it's down nicely from the highs, but kind of building on this last conversation here, if you step back over a long period of time and look at retail, which is there's obviously a bunch of different buckets that go into retail, but retail has been over earning like crazy for the last couple of years. Profit margins are way higher than historical levels because gross margins went higher, and there's a lot of operating leverage in these models because the margin profiles are pretty thin typically for retail. So a lot of record retail profits are never going to be seen again. And as the consumer slows and continues to slow, I think a lot of retail is mispriced. XRT, for example, the largest holding is Carvana, which I expect will be zero for equity in short order. So and that's one way I've expressed my bearish view on retail is through June 65 and $60 strike XRT puts, as well as January 24 $70 XRT puts, which I look today and I think I'm up like 40% on those across the board. And I didn't trim any today, so I'm sure next week we're going to go back to all-time highs.
Yeah, we need the inverse Rod ETF to open up already. We're waiting on it.
Chris is subscribed to that inverse rod ETF. Hey Chris, how are you?
Hey, how's it going? I don't know about this inverse rod thing. I'm not really subscribed to that. I've never heard of that. But I was gonna mention for this week, I've been tracking a few of these um, merger arbitrage plays, and there's a few of them that have some interesting news. I think there's the Activision Blizzard merger, right,
Yep.
with Microsoft, and there was news about a Nintendo deal. It was rumored back in December, but it's official that Microsoft has offered 10 years of Call of Duty to Nintendo. Um, I guess people were like reacting to that, like, oh, that was going to happen. They already had said that they would, but now it's like official. Not sure about the other games. They probably will, but we don't know yet. There's also this merger um, between VMware and Broadcom, and that one currently trades at around a 20% discount to the deal price. I believe it's like $142 per share in cash of VMware stock, and then the stock, I think yesterday it was around 113. I don't know, but I didn't look at it today.
It's around there.
Yeah, and that deal, basically the deadline got extended by another 90 days, I believe. It was a couple days ago, it got extended. So there's a little bit of life, brought into that play, breathed into that play. And then there's the Spirit Airlines merger with JetBlue. And there was some regulator a few days ago that basically okayed the deal. They said we don't have a problem with it. I don't remember exactly which regulator, but that one's interesting as well. I think that one trades like at a 40-50% discount. It's like pretty big.
Have you looked at the iRobot deal at all? Because that's another
I
one that
heard
has a
about that
huge
one.
discount.
Yeah, that's the Amazon one, right?
Yeah.
Yeah, I haven't looked at that one very closely.
And for folks maybe who aren't familiar with merger arb, could you maybe explain like I'm five way, kind of talk through what it is that you're doing there and how those plays work?
Yeah, so these are companies that have already been offered to be bought out, to be purchased by a larger company, right? And but the deal hasn't been approved by regulators. It hasn't been closed yet. So, a great example Rod likes to bring up is the Twitter deal from last year. Elon announced that he was going to purchase Twitter for $54.2 per share. Twitter accepted the offer, right? That was back in April, I believe. But in the ensuing months, there was a big, kerfuffle about the deal, whether it was on or was off. Elon wanted to pull out. There was this clause about specific performance that, well, I'm not explaining like I'm like you're five, but basically there's uncertainty about the deal that it'll go through, and that creates a discount. And then for the Twitter deal, it was a pretty large discount and it finally got closed, and that was a cash deal, so it was paid completely in cash to Twitter shareholders.
Yeah, so I'm looking at the Twitter chart and I have it up now. Again, if anyone's following along live, obviously if you're watching the recording, you're seeing the screen. But Twitter traded below $40 just immediately before the deal. Now remember, there was other, as there always is with Elon Musk, shenanigans going on leading up to that, right? He accumulated a more than 5% stake in the company. He initially filed on Form 13G, which we talked about back then. Actually, we did a shareholder activism discussion that we focused on GameStop. You can check it out on our Wook Capital YouTube if you want to catch that replay. I thought that was a fun talk. That was like a year ago we did that. But he basically went past 5%. He said, I'm going to be a passive investor. Then he filed belatedly. You're supposed to file within 10 days of passing that threshold. So he filed belatedly. He also filed on a passive form when then mere days later he refiled it as a 13D. as an activist, and the offer finally came in early April, where the stock had gotten up to about 39. Then it ramped to, as you noted, close to the deal price. It ramped to 50 or so, and then by May, come summertime, he was trying to get out of it, even though he had agreed to the deal and waived his due diligence. He came up with all these reasons why he thought he should get out of it. They went to court, and before the court could rule, he ended up deciding to consummate the deal at the agreed upon price, which I know a lot of people who bought the stock say after it traded down into the 30s, after the deal had been agreed upon at 50, what was it, 52.69 or 52? No, 54.20. Sorry, 54.20. Yeah. So there's a lot of money made on that merger arc, but thank you for the walkthrough for anyone listening who is not so familiar. I mean, that is definitely a spot if you have a lot of cash, and you want to just kind of monitor and find interesting opportunities. I know that like merger arb is something that, what do they call it? Workouts, right? Like Buffett and co did a lot of over their career. So it's definitely a real strategy. It involves substantial work though to try to really understand, is there a mispricing, right? Because you have to figure out what is the likelihood the deal will close. You need to have presumably a variant viewpoint from the market, a better viewpoint than the market on one of these deals. The Twitter deal was just a bizarro thing.
Yeah, and I mean, a lot of times these things just take time.
Yep.
And like, for example, the Twitter deal, it took like 6 months or so, and people don't really have the patience, especially when there's some uncertainty. And like with the Activision deal, that was announced over a year ago.
That's right.
And we're still not closed yet. So like people who bought back then, hoping for that to close, have basically not made any money for a whole year, or potentially lost money. I think it's about even.
Yeah. So it was in January, right? Because I'm looking at the stock chart. It traded in the mid 60s. Activision did before the announcement. Then it jumped up to 81 and change. And really, since the beginning of 22, it's just been a sideways and slightly down move. It's now trading at 77. So you're right. Money that you allocate to these positions could be locked up for a year or more. There's obviously opportunity costs. Depending on if you're going to incorporate any options strategies, there's a lot of different ways to play these things. But yeah, merger arb is definitely. If you have a lot of cash right now, I think it's worth investigating and trying to learn more and identify interesting plays, and definitely start small.
Yeah, I think one other interesting thing, just generally, like speaking about the market, right? Just for like just to review, I think the Biden administration's approach to antitrust is an interesting thing to study. He hired, I think, in his cabinet, he had this guy. I forgot his name, but he was like the spearhead for his antitrust campaign, and he resigned. I think, or he resigned, or he was let go at the end of December. So that was interesting. I need to go look it up again. Biden, head of antitrust. But I
know that at the FTC that he brought in Lena Khan, whose like whole career was around how Amazon is very much a anti-competitive entity, and yet now they've not really pushed back. We talked about this on Wednesday. There was a medical devices purchase that FTC didn't push back on. Obviously,
was it Lena Khan?
Yeah.
She resigned last week.
She did? Oh, geez. Shows you how little I pay close attention to.
A week or two ago. Yeah, so there was his cabinet member, then now Lena Khan has resigned.
I will soon resign as an FTC commissioner on the 15th or 14th. Got it.
Yeah, I mean, this is not, either way, it's not going to really tell you, but it's a good, it's a good thing to watch, I think, in the market, as, we have Google, we have, Microsoft, we have Apple, big companies, and NVIDIA, like you said, they have 90% of the market, right?
Are you sure Lena Khan is the one resigning? I'm reading that it was one of the other commissioners that's resigning.
maybe it says hit by resignation, the headline, so maybe I misread that.
Yeah, so it's one of the other commissioners that's shitting on Lena Khan in their resignation.
Oh, okay. Well, that's interesting.
Yeah,
Yeah, so it isn't her.
Christine Wilson is the one who resigned on the 14th. She posted an op-ed. I'm looking at the Wall Street Journal op-ed.
Spicy.
Interesting. But yeah,
so like
regulatory risk is definitely a real factor in a lot of these merger arb opportunities. And it's, like with Activision Blizzard, Microsoft is trying to lock in, like you said, with Nintendo, you can have Call of Duty for 10 years. With PlayStation, you can have Call of Duty for 10 years. Microsoft's like, we're not going to do the deal if we can't get Call of Duty. That's primary.
This is the headline on Fortune. Republican regulator rips Lena Khan in noisy exit, accuses hipster antitrust boss of breaking the law by having opinions on Mark Zuckerberg. So
that's right.
Clearly, some of these people in admin are very opinionated. You'd want to be impartial, right?
I think Wilson's a Trump appointee, right?
Yeah, I mean, it's a partisan thing, I guess.
Yeah.
But yeah, I mean, I think there were some antitrust scares over the last 5-6 years or so, especially after 2017, as these companies got really big. But nothing is really stuck. I mean, I can't think of anything in recent memory that the government has really. I mean, Trump was very lax with the antitrust. So I don't know. I mean, maybe Biden
wasn't Meta. Didn't they try to buy Jiffy, and that got antitrust, which seemed.
Yeah, that's weird. That's strange. Yeah, I don't know. I didn't hear about that one. But yeah, generally, I think the Instagram one got revisited. They looked at it. They said, "Hey, like this was messed up," but like it
was British antitrust. I'm sorry, it wasn't U.S. antitrust. Oh, okay. But Meta sold Jiffy because the UK had an antitrust order on it. Which again, I don't know how a GIF platform could possibly. But
I mean, they could have just sold it for business reasons.
I'm tech and illiterate.
I mean, they could have just sold it for business reasons. I mean, who knows?
I mean, the headline is Meta. Not the headline. The sentence is Meta has been ordered by the UK's competition watchdog to sell animated GIF platform Giphy, and this time it's final. This is from October of last year, so I don't know how that sort of thing is antitrust, but then other things aren't.
Yeah, I think that's another thing that really adds to the discount with these companies, because the law is kind of, the way it's applied doesn't really make sense in a lot of these cases.
Indeed.
Yeah. So, yeah. Anyways, I think that's another thing to watch over the next few months. I'm curious as to see, it's been 2 years of Biden, and we don't really know exactly. He said that, he wants to go after these big monopolies, but we'll see what he does, or his administration does. But yeah.
Good stuff. Well, thanks for chiming in. It is 5:02. I'm going to, again, kind of ask if anyone in the audience wanted to chime in on any of the topics we covered. Please feel free to put your hand up, come up as a speaker. Otherwise, yeah, I'll probably wrap us up, and we can let everyone start their weekend. Joe, anything else you want to add? I don't see any other hands going up before I close this out.
No, nothing else to add.
All right. Okay, well, thanks then, folks.
It's been about an hour-long call. I think it's covered quite a bit.
Good, yeah. Well, good. So speaking of calls, we, as I mentioned at the onset, we'll have our Wook Book Club on Tuesday night, 8 p.m. Eastern. The Spaces link is here under the Wook Capital profile. Set a reminder for that. We'll be back on Wednesday at 7 p.m. with our market open mic that we host weekly. I host that under my personal account at Rod Alsman. And then we'll be back next Friday with our 22nd edition of the Wook Review at the close. So if you're not signed up for the newsletter, please click the link in the Wook Capital profile and be sure you're getting that. Again, we're never going to be selling you products or services. Our intention is to continue to build out an investor information network where we can pursue alpha through collaborative crowdsourced research. So we have more to come on our Wook watch list, stock watch list that we'll be sharing in short order here as we look to get some interesting and hopefully informative and fun bull versus bear spaces broadcasts on those top stocks. We have GameStop earnings coming up in later on in March, as well as Playboy, PLBY earnings. So we'll cover both of those. And there's some others that we'll get in the mix as March rapidly comes upon us next week. So thank you very much, folks, for tuning in. Hope everybody has a great weekend. Cheers, everybody.